Starting on August 20th, Chinese Premier Li Qiang visited Russia for 3 days, holding the 29th regular meeting with the Russian foreign minister. As Russia remains embroiled in war and faces economic sanctions from the US and Europe, Li Qiang's visit is seen as a signal to Western nations that Xi Jinping stands firmly with Russia, helping the country overcome its economic challenges. Upon arriving at Moscow airport, Li Qiang was met with a grand welcome ceremony and promptly went with Russian President Vladimir Putin at the Kremlin. Putin announced that the BRICS summit would be held in Kazan this October and extended an invitation for Xi Jinping to attend. According to Russian media, both sides signed multiple agreements strengthening their comprehensive strategic partnership and cooperation across various sectors, including trade, economy, industry, and energy. Li Qiang stated that his visit aims to implement the consensus reached between the two countries' leaders, continue their long-standing friendship, and deepen mutual beneficial cooperation. On August 22nd, the Chinese and Russian premiers issued a joint communiqué following their 29th regular meeting, agreeing to strengthen and develop their payment and settlement infrastructure. Reports indicate that the measures to be implemented include opening correspondent accounts in both countries, establishing branches and subsidiaries, expanding cooperation in the banking and insurance sectors, and maintaining a high percentage of local currency settlements in bilateral trade, investment, loans, and other economic activities. The report reveals that the cooperation between the two powers is not without challenges. Since the US expanded its sanctions at the end of the last year, the Chinese authorities have had to consider measures for self-preservation. Payment and settlement in China-Russia trade have become the most pressing issue, with Russia now reliant on China's cooperation. Once a dominant force, Russia is now facing severe material shortages, relying mostly entirely on China. Meanwhile, China, once the junior partner, now acts like a savior to Russia, helping the country circumvent Western economic sanctions. As Xi Jinping believes he holds the upper hand in the China-Russia generations of friendship narrative, the trade cooperation between the two is in an awkward situation. Russia's Investia reported on August 12th that despite China's becoming Russia's largest trade partner and China-made products flooding every sector of the Russian market, 98% of Chinese banks, including smaller local banks, are now refusing to accept direct payments from Russia. Trade between China and Russia has thus shifted from open transactions to underground operations. China and Russia have long been trying to de-dollarize their bilateral trade and reduce reliance on the global dollar settlement system. After Russia invaded Ukraine, several Western countries decided to expel certain Russian banks from the SWIFT payment system. This action was viewed as one of the financial sanctions against Russia. SWIFT is the most important and convenient platform for international banking communications, connecting over 11,000 financial institutions in more than 200 countries. Over half of Russian credit institutions are SWIFT members. To help Russia reduce the impact of Western sanctions, China has encouraged Russia to expand its use of the Cross-Border Interbank Payment System, or CIPS, accelerating the adoption of the Chinese yuan. On March 21, 2023, after Chinese President Xi Jinping met with Russian President Vladimir Putin in Moscow, the two leaders signed and issued a joint statement outlining 8 areas of cooperation with one key focus on increasing the use of the yuan for settlements. CIPS, developed by the People's Bank of China in 2015, facilitates cross-border yuan payments, providing clearing and settlement services for its members in trade and finance, but its scale remains relatively small, with around 100 banks directly participating. According to the International Monetary Fund, IMF, the yuan is currently the 5th largest international reserve currency and the 5th most used payment currency, with a 3% share. The top 4 currencies are the US dollar, the euro, the British pound, and the Japanese yen. With over 11,000 members, SWIFT includes about 300 Russian financial institutions as participants, while only 24 Russian banks are connected to China's CIPS. Due to China's Belt and Road Initiative, which involves extensive infrastructure projects in cooperation with various countries. Much of the financing for these projects is provided by China. This creates a significant amount of yuan-denominated assets. For instance, in mid-April, Bangladesh and Russia agreed to use yuan for payments related to Russia's nuclear power plant construction in Bangladesh. Countries like Argentina and Brazil have also announced plans to use yuan instead of the US dollar for paying for Chinese imports. Nations such as Russia and Iran have been forced to use yuan for settlements due to US sanctions. After losing its SWIFT membership, all financial institutions in Russia have switched to using CIPS. It can be said that amidst the Russia-Ukraine war and Western sanctions, China has emerged as the biggest winner. Not only has it gained control over Russia's economic lifeline, but it has also reaped significant benefits. In response to the sanctions, Russia has shifted its trade away from the West and towards China, purchasing a wide range of Chinese products, from cars to computers. In return, Russia sells oil and natural gas to China at steep discounts. Russian products like chocolate, sausages, and other consumer goods are now commonly found in Chinese supermarkets. In the first 11 months of last year, trade between China and Russia surpassed $200 billion, a level the two countries had originally projected to reach by 2024. Chinese state media has also supported Russia's war in Ukraine, frequently criticizing the West, while Chinese netizens often portray Putin's aggressive actions as justified. According to Russian reports, before the Russia-Ukraine war, the yuan accounted for only 0.32% of Russia's total foreign exchange transactions. By December 2023, around one-third of Russia's foreign trade was settled in yuan. By this May, the yuan accounted for 53.6% of trading volume on Russian exchanges. In June, under US sanctions, Russian exchanges completely halted trading in dollars and euros. It makes the yuan the only liquid currency available for trading and purchasing in Russian brokerage accounts, soaring to almost 100% of transactions. Media reports show that nearly all trade between China and Russia is now settled in yuan. Moreover, Russia's yuan-denominated exports have surpassed its exports to China, indicating that other countries are also using yuan to settle transactions with Russia. Additionally, Russia's largest bank, Sberbank, began offering yuan remittance services within Russia to its clients starting in April. The shift to yuan-denominated international trade initially excited Chinese netizens, who saw it as a chance for the yuan to challenge the US dollar, at least by contributing to the survival of Russia's international trade. Russia too once believed that by bypassing the dollar and euro, yuan settlements would resolve its trade difficulties. Some commentators believe that the sanctions imposed by the US and Europe on Russia are akin to a black cat sheriff catching a mouse. The cunning mouse, with the help of the Chinese government, has repeatedly evaded sanctions, with the removal of the US dollar and euro from Russian exchanges. China-Russia trade is now facing a severe blow, signaling a warning to China not to get burned in the process. Last December, the US implemented secondary sanctions to prevent Russia from evading the primary ones. These sanctions targeted financial institutions assisting Russia in circumventing the restrictions, causing banks from China, the UAE, Turkey, and Austria to reduce transactions with Russia to avoid becoming sanctioned targets. An official from one of China's 4 major state-owned banks revealed that they have tightened scrutiny on Russia-related business to mitigate the risks of sanctions. The official stated, "The main reason is to avoid unnecessary trouble." By early this year, not only China's major commercial banks, but also local banks such as Ping An Bank, Ningbo Bank, and Guangfa Bank completely stopped accepting payments from Russia. Industry insiders noted that these transactions are easily tracked by the US. According to an April report by Reuters, a home appliance manufacturer in southern China is finding it difficult to ship its products to Russia. This is not due to product issues, but because China's major banks are restricting payments from such transactions out of fear of US sanctions. The founder of a Guangdong-based company, Mr. Wang, mentioned that in order to settle payments for his electrical products, he is considering using currency brokers who are active along the China-Russia border. Some banking sources revealed that a Chinese major bank withdrew financing for Russia-related transactions. Some Chinese businesses are turning to smaller banks near the border, underground financing channels such as currency brokers, and even banned cryptocurrencies. A Russian banking official in Moscow noted that using cryptocurrency payments may be the only option, although China has banned the use of cryptocurrencies since 2021. Since then, payment transactions between China and Russia have moved underground. Reports suggest that some payments are being handled by smaller banks under larger financial institutions, which are less involved in major international trade and can avoid direct sanctions. But this time, the US seems unwilling to let up, continuing to block all escape routes for these underground transactions. At the G7 summit held in Italy this June, weakening Russia's economy was once again the top priority on the agenda for the US and Europe. The US decided to expand its definition of Russia's military industry base and implement further secondary sanctions. Under these secondary sanctions, the US has the authority to blacklist any bank worldwide that does business with Russian financial institutions already under sanctions. This has forced Moscow's exchanges to suspend transactions in dollars and euros, exacerbating payment issues for Russian companies. With the yuan being the only remaining currency for foreign exchange payments, smaller banks in China and other regions have become key targets for these intensified sanctions. According to reports, the US has discovered that while China's trade with Russia appears to be limited to civilian sectors, behind the scenes, China has been supporting Russia's defense industry, using small local banks to circumvent US sanctions. The US has repeatedly issued strong warnings to China not to supply weapons to Russia. Although no evidence of China doing so has been found so far, some civilian equipment sold by China to Russia has dual-use capabilities, such as drones and trucks. On May 31st, during a press conference in Prague, U.S. Secretary of State Antony Blinken stated that 70% of the machine tools imported by Russia come from China, as well as 90% of its microelectronics. Blinken remarked, China cannot expect, on the one hand, to improve relations with countries of Europe, while on the other hand, fueling the biggest threat to European security since the end of the Cold War. The implementation of secondary sanctions has caused more Chinese banks to avoid conducting payments and foreign trade settlements with Russia. Currently, reports on mainland trade forums indicate that some small and medium-sized banks friendly to Russia, such as Hunchun Royal Commercial Bank, have issued notices suspending cross-border remittance services as of July 23, 2024. According to Reuters' report, citing Russian insiders, Russia is not a priority for Chinese banks. Although trade between the two countries is booming, China's trade volume with the US and the EU is still much larger. They are not willing to jeopardize their own markets to facilitate payments to Russian companies. Several major Russian commodity experts told Bloomberg that since the US expanded sanctions in June, more yuan-denominated direct payments have been frozen or delayed, turning trade with China into a gamble. In July, unnamed large Russian commodity exporters also revealed to Bloomberg that trade with mainland China has become increasingly difficult, with even direct payments in yuan being frozen or delayed. In July, some Chinese buyers of Russian agriculture products faced payment issues. The Russian Automobile Dealer Association warned that car and auto parts imported from China might halt due to settlement problems. In early August, Russia's Business Gazette reported that trade payments between China and Russia now take up to 6 months to settle, due to Chinese banks strengthening compliance checks out of fear of Western sanctions. Business Insider, citing Business Gazette, stated that around 80% of yuan remittance are eventually returned after weeks of delays, with no explanation provided. This could result in Russian companies facing losses in exchange rates and transaction fees. Russian media reports also indicate that to bypass these increasingly stringent restrictions, some Russians seeking to purchase goods through Chinese companies are now resorting to intermediaries, which adds additional costs. And so-called intermediaries are agents based in former Soviet republics who act as go-betweens for these transactions. According to Russia's Investia, since July, applications for proxy payment transactions through third countries have surged several times over. Alexander Padovin, an analyst at Finim in Moscow, told Bloomberg that cross-border payment issues have become a critical challenge for Russian companies in 2024. Padovin also mentioned that Russian banks are now encouraging the use of cryptocurrencies to bypass Western sanctions and facilitate cross-border fund transactions. Settling payments through cryptocurrencies via Hong Kong is becoming increasingly popular, but intermediaries from countries like Uzbekistan and Kazakhstan are often needed. Due to the looming threat of US sanctions, Hong Kong banks are reluctant to engage directly with Russia. According to a Reuters report from April, half of Russia's payments to China are made through intermediaries in friendly regions such as Hong Kong, Kyrgyzstan, Kazakhstan, and the UAE. But these intermediaries may charge commissions of thousands of dollars per transaction. If third countries are involved, there is also the risk of goods being seized. Reuters, citing Russian insiders, noted that while trade between Russia and China continues, the significant increase in payment costs is undoubtedly driving up overall expenses. An expert in Russian regional issues at Moscow State University, Natalia Zubrevich, commented that difficulties in inter-country payments are worsening the situation, particularly with regard to imports. She added that Russia's consumer market is deteriorating and is expected to worsen further. Professor Frank Xie from the University of South Carolina, Aachen, believes that while U.S. sanctions are driving up transaction costs for Russian importers and exporters dealing primarily in yuan, but China's exports to Russia are unlikely to see a significant decline in the second half of this year. Professor Xie said this is because China has made a so-called no-limits commitment to cooperation with Russia. Additionally, China's exports to Europe and the US are already declining. If China cuts off exports to Russia, it would also deal a severe blow to its own economy. Chinese Premier Li Qiang's visit to Russia, his meeting with Putin, and efforts to establish bank branches to resolve currency payment issues face uncertainty as to whether they can evade the relentless sanctions from the US and Europe.